What does it take to move a currency? Japan just discovered that a staggering $74 billion isn't enough. Despite a record-breaking 11.7 trillion yen intervention by the Ministry of Finance back in May, the yen is still struggling near the 159 level against the dollar. By the end of this video, you'll grasp why this monumental spending failed, the structural trap Japan finds itself in, and why all eyes are now on the Bank of Japan's mid-June decision. The fuel for the yen carry trade is still burning, and the market is calling the government's bluff. The Ministry of Finance has confirmed a staggering expenditure of nearly 11.7 trillion yen between April 30th and May 29th. This amount exceeded every market expectation. Historically, such a massive injection should have sent the dollar reeling, yet the effect was minimal, less than 1 yen. The core issue lies in the interest rate differential. With Japan holding near zero rates while the US remains high, there's a daunting 300 basis point gap that positions the yen as the ultimate funding currency for carry trades. Traders are effectively incentivized to bet against the yen, and as long as that gap persists, intervention merely offers a more favorable entry point for short positions. The scale of the defense is truly staggering. Finance Minister Satsuki Katayama has reiterated that authorities are prepared to step in again if volatility continues. However, the data reveals that yen shorts surged from 61,000 to nearly 94,000 contracts in just 2 weeks following the last intervention. Japan is depleting its foreign exchange reserves at a time when emergency import demand is soaring. Purchasing costly dollars at 159 to cover energy and food imports is adding fresh pressure to the currency, creating a vicious cycle where the intervention itself underscores the authorities' desperation. Market participants on X are highlighting that intervention alone doesn't work as long as the carry trade fuel remains. A prominent view is that the Ministry of Finance is merely cutting shorts temporarily, only for them to be rebuilt at more attractive levels. Traders are now laser-focused on June 15th and 16th, when the Bank of Japan meets. The consensus is shifting. Many believe a rate hike is the only measure that can unwind all of it. Without a policy shift from Governor Ueda, speculators feel secure staying short because the cost of holding the yen is just too high compared to the dollar or even the Australian and New Zealand dollars. Economic analysts are drawing parallels to other global shifts. While Japan faces challenges, Canada has slipped into a technical recession, and commodity currencies like the NZD and AUD are showing resilience. Analysts point out that an inflationary regime typically favors commodity-linked currencies and the US dollar, leaving the yen, euro, and pound vulnerable. Some traders suggest that the BOJ could be the hike that changes everything. If they act in June, it could trigger a massive repatriation of Japanese capital. Until then, this record intervention is viewed as a temporary dam against a massive structural tide. The yen at 159 is a double-edged sword for the Nikkei 225. While it enhances profits for major exporters when they repatriate earnings, it's becoming a nightmare for the broader economy. Import bills are skyrocketing, and the Bank of Japan is also facing stress in the 40-year bond market, which has recently hit all-time high yields. This bond market stress indicates that capital is already beginning to shift in anticipation of higher rates. The record intervention may have failed to move the currency, but it has certainly signaled to corporate Japan that the era of a stable, weak yen might be coming to an end in a very volatile manner. Beyond Japan, the US dollar index, or DXY, is at a critical juncture. There's a strong correlation between the dollar's strength and crude oil prices. If the DXY breaks key resistance levels, it could trigger a global liquidation of dollar shorts, complicating the MOF's efforts even further. Additionally, geopolitical shifts, such as the strengthening partnership between Poland and Germany in response to security threats, are redirecting global attention and potentially altering capital flows across Europe. In this inflationary environment, the yen's role as a safe haven has been completely overshadowed by its function as a cheap funding source, a dynamic that won't change without a significant policy pivot from the BOJ. For individual investors, the current environment calls for extreme caution. The carry trade fuel, the rate gap, remains very much alive. Betting on a yen recovery based solely on intervention has proven to be a losing strategy in May. The key indicator to watch is the BOJ's stance on bond purchases and their willingness to hike rates on June 16. If the BOJ disappoints the market with a dovish tone, we could see USDJPY challenge the 160 level again very quickly. Investors should be on the lookout for signs of institutional yen buying that might precede the official meeting, as some funds may begin positioning for a structural shift. Looking ahead to mid-June, we see three primary scenarios unfolding. In the base scenario, the BOJ reduces bond buying but keeps rates steady, likely leading to USDJPY hovering between 158 and 160 as the carry trade persists. In the bullish yen scenario, the BOJ surprises everyone with a rate hike and hawkish guidance, potentially triggering a massive unwinding of yen shorts, pushing USDJPY back toward 150. Conversely, the bearish yen scenario occurs if the BOJ remains dovish and the Fed signals higher for longer. In this case, further interventions may not prevent the yen from breaking past 162, as the market realizes the MOF is fighting a losing battle against the interest rate tide. To wrap up, first, the record intervention has failed to reverse the yen's weakness. Second, the 300 basis point rate gap remains the primary driver for speculators. Third, all eyes are on the June 15, 16 BOJ meeting for a potential policy shift. What do you think? Will the Bank of Japan finally pull the trigger, or is the yen destined to stay weak? Let us know in the comments, and don't forget to subscribe for more in-depth analyses of the Japanese macroeconomy. See you in the next video.